Hello, it's Friday, the 20th of March. We're going to be talking, of course, about Iran again this morning. We're about to have the third week of this conflict. Market response so far has been obviously concerned, but it felt over the last week there was a sort of growing anxiety out there in a general sense, and we'll dig into why in a moment. But perhaps one of the most obvious reasons was a sort of a broadening of some of the strikes on gas infrastructure, in particular in Qatar. And so we saw a response in the gas futures price that perhaps we haven't really seen so far. Most of the energy shock had been confined to the oil market, so a broadening in there in terms of the risks and the impact potentially on economies worldwide. Gas has increased substantially. It hasn't quite hit the levels it hit in 2022 yet, when we had the Russian invasion of Ukraine and the inflationary spike that came from that. Oil has continued to push up. It's a little bit off its highs of yesterday, around about the 110 level, which given the start of this year, we were below $60 a barrel. We've more or less doubled in pretty short order in terms of the oil price. So substantial moves, both in terms of gas and in terms of oil so far this year. And the concern around that, of course, is an inflationary one. There's lots of different ways inflation could pan out from here. I suppose the most positive possibility is if we have a quick resolution to what's been going on in the Middle East, or simply a quick opening up of transit of oil and gas, particularly oil through the Strait of Hormuz. You might find that oil price starts to come back down and those inflationary concerns start to dissipate, in which case you'd see an inflationary spike as the initial shock sort of comes through in terms of pricing, but it remains very much a sort of transient feature, and we move on from there. That's probably the best case we can hope for at this stage. So the middle of the road scenario might be that energy remains elevated. You'll still get that inflationary spike. The inflationary impact then, of course, dissipates. You have this thing called base effects where, your input prices go up. That creates an inflationary impact. But once that going up has happened, the inflationary impact of that price move stops, because essentially oil then sits flat, for example. It doesn't, in and of itself, have an inflationary impact. So that's the sort of middle of the range scenario. And the worst case in terms of inflation, this sort of stagflationary idea, is where inflation remains elevated. It gets baked into consumer expectations. They anticipate having to pay more. They go and negotiate wage increases as a consequence. You get a sort of a self-fulfilling inflationary cycle where prices go up, people get wage increases, which allow prices to go up further. And that's the sort of the main scenario that governments and central banks really very clearly want to avoid, because a little bit of inflation is no bad thing. And the levels we sort of alighted on in the last year or so, the sort of threes, are not too bad. Generally, governments and central banks target a lower level than that. They're targeting around the twos, but a three is not too unhealthy, and certainly not unusual if you look through a historical lens. But if it elevates and sits higher than that, and indeed sort of crimps growth, you can see why the concerns are, clearly occupying the minds of governments and central banks, and something they want to avoid. So have we had any signals from governments or central banks around their concerns about inflation? Well, this week we have had some. We've had the interest rate decision of the European Central Bank and indeed the Bank of England, the BOE, both deciding to do nothing, to leave interest rates unchanged. The expectation at the start of the year in the UK, for example, would have been for a cut. But clearly now the situation has moved from a sort of lowering of inflation to a potentially more inflationary environment. The Bank of England made the decision to not decrease interest rates. And the accompanying statement was interpreted as being quite hawkish, quite likely to imply interest rate increases down the track. So the voting of the committee was unanimously in favour of sitting still. And the accompanying statement was also deemed to be relatively hawkish, relatively concerned around about inflation. And so, in fact, in the futures market, it's now expected that, or priced in, we should say, probably more accurately, that you'll get 70 basis points increase in interest rates over the course of the year, having started the year obviously with expectations of interest rate cuts. And all of this impacts the government bond markets, and most importantly, it impacts the short end of the government bond markets at the moment, because it's looking at the shorter term debt. Interest rate policy tends to impact the short end more substantially than the long end. We've had some big moves. The biggest move in the 3-year gilt yield upwards since 2022 yesterday. So some big moves in the short end of the curve. The long end is moving around, not just in the UK, but in other regions as well. We're starting to see them move up as well. The 10-year is the sort of middle of the curve. That's starting to move up. The UK is in the sort of high fours, not sort of crossing that threshold into 5, around about 4.8. It's the sort of level actually we still also saw even in early 2025. So it's not as an outlandishly high level yet by sort of historical comparisons, even recent history, but it has moved up, and again, sort of reflecting higher cost of capital, higher cost of debt in particular for governments. Got to service that debt. It's harder in an environment where interest rates are higher, and that's why governments have been really trying to get interest rates down over the last few years. It increases the debt burden quite substantially. The servicing of it gets harder. So governments will want to see that come down, but at the same time, they're concerned around sort of inflationary spiral and allowing central banks to, try and talk that inflation down by giving a strong indication they will be active to try and rein in inflation by moving that base rate up as and when necessary. So a bit of a sort of mixed bag in terms of messaging. Clearly some concern around the inflationary impact, and whether that is the best case sort of a short inflationary spike, or whether it may linger and it could even sort of trip into that stagflationary environment, which is the one that governments really want to avoid if possible. The equity market response remains mixed. We've had a couple of more challenging days this week in particular as concerns mounted. But it's been a sort of mixed bag overall in terms of year-to-date equity market performance. US is now down a few percent year-to-date. Similar picture in Europe, both in sterling terms, around about sort of 2-3% so far in sterling terms. The UK stock market up around 1% year to date, and Japan's actually up around about 6% in sterling terms year to date. So a mixed bag in terms of equity market response to the news flows so far. UK, of course, having a reasonable density of energy related names certainly would have helped over this period. So it again goes to show that diversification in times like this doesn't have to just be equities and bonds. There's lots of other ways you can get diverse and indeed differentiated returns in the portfolio. So it's an interesting response, I suppose, from market participants. They remain concerned. They remain, anxious. Clearly, you're seeing that come through in terms of market performance, and certainly the density of negative days seems elevated over the last few weeks. But overall, the stock market picture so far has been, cautious and concerned, rather than really in the sort of high alert category as things stand today. Needless to say, as the information changes, we'll update you, and we'll obviously remain, alert to these changing conditions from a portfolio management perspective as well. But as things stand, really being diversified, having lots of different returns drivers, being patient and not overreacting to negative news flow has been as a pretty sensible way of looking through these markets currently. That's it from me. Have a good weekend when you get there, and we'll see you next time.